Hi, and welcome or welcome back to the Future of SaaS Festival. We hope you're enjoying the presentation so far. Just a quick reminder, if you're not already a member of our Slack community, follow the link at the top of the event website to network and join the discussion. Hello everyone, and thank you all so much for joining us. We're just having a little problem with our first speaker, I'm afraid, so please do bear with us. In the meantime, as I mentioned in the video just down there, do check out our Slack channel. You can chat with all the other attendees. You can even meet some of the speakers on there. So do have a little look around. You can also check out our website at futureofsaas.io. So please bear with us just whilst we're having these few issues, and we'll hopefully be back soon. Hello again, everyone. Thanks so much for your patience. So we do have Edward here. He's just joining at the moment, so he'll take a couple of minutes to get his microphone and camera working. Thank you so much for your patience. So in the meantime, do let us know where you're tuning in from. We'd love to hear from you. So let us know where you're tuning in from. Say hi to everyone else, and Edward will be with you in just a moment.
Cool. Hopefully I'm now on. Nothing quite like a technology presentation going wrong to start with. Gemma, can you hear me?
Yes, absolutely. We've got you now. So thank you so much for joining us. Yeah, I'll hand over to you. We've got our attendees with us all tuning in, letting us know where they're from. So I'll hand over to you now with making your SaaS company attractive for investment. Thanks so much.
Brilliant. Thanks so much, Gemma. Cheers. Well, thanks, guys. First of all, apologies for my backdrop. I've had an absolute a nightmare today, and the internet in my office stopped working. So I'm in my daughter's bedroom, which is why there is a massive, if you can see it, poster of a rabbit on the wall. But there you go. Nothing says kind of lockdown conferencing like a big poster of a rabbit on your daughter's bedroom wall. That's where I'm presenting from today. So I hope everyone else has had a good pandemic year. But thank you so much for joining. And this is a classic example why pre-recording is sometimes the better way, but I've decided not to. So you're getting the full live experience. So I'm really pleased to be talking about making your SaaS company attractive for investment. Very quickly on me, my name is Edward Keelan. I'm an investment director within the Octopus Ventures team at Octopus, which I will come on to. Other thing, quick apology for the speed in which I go through this. I decided to run through my presentation this morning. It took me about 3 times as long as time as I've got today. So if anybody does have any questions from anything I talk about coming out of this today, please let me know. Find me on LinkedIn and feel free to ask separately. So this is the usual slide that we put up, which is basically don't rely pretty much on anything that I tell you today, and that no past performance is not an indicator of future, etc., etc. So the agenda, rough agenda. I'm going to talk a little bit about Octopus, not very much, around why investors love SaaS, how to make your business attractive for investment, and avoiding mistakes. I'll be honest, it's a bit more kind of things that pop into my head and thoughts that I've had as an investor over the last decade of things that companies should look out for. It's probably not as much structure as this agenda suggests. So in terms of Octopus, we've been around for 20 years now, and really we wanted to be a sort of friendlier face of investing. It's been a successful mantra. We manage over 10 billion of funds under management, and we do that from everything from renewable energy through to early stage companies. We also are known for our energy supply business, Octopus Energy, as well, which has sort of been born out of the back of a lot of the work that we've done in renewable energy. The team that I work with is the Octopus Ventures team, and specifically on B2B software. And we're looking at B2B software, and with that, clearly SaaS is a big part of it, really through all the different stages of growth and size. And so I'll probably say nothing more than if you are a SaaS company and you're looking to raise funding, then I'd love to speak to you. Connect with me on LinkedIn and let's open up the conversation. So on to the first slide, which is why do investors love SaaS? And yeah, we really we've been looking at SaaS really for a decade, but I certainly remember sort of 5 years ago thinking about multiples of annual recurring revenue, multiples of sort of 4 times, and thinking that sounded very high. But like anybody trying to predict a market, that has just gone up and up. SaaS Capital is probably one of the best companies at providing data around this. And you'll see even in the pandemic year where many other industries were struggling, SaaS companies really did very well. And I mean, the reason why this is, there's 2 things that investors love even at a sort of VC level, which is one, cash and kind of generation of cash, which SaaS companies do very well, and also a kind of a predictable and recurring revenue stream. So 2 of the main things that investors look for, you find within a SaaS business. My word of warning, anybody that pretends that they can predict a market is a bit of a fool in my book. I don't think anyone can predict markets particularly well, especially not me. But I do think from more of a qualitative level that we may see valuations coming down. And the reasons why I say that, the main reason I say that is not just because, you could say there's a bit of a bubble, but more I just think that companies will look harder and harder at their IT spend around SaaS. So I'm already now seeing companies, for example, a SaaS company whose SaaS model is to look at the usage of other SaaS in the company. So their mantra is that the average large company will have 100 different SaaS products and only half of those will be used. And therefore you need their technology and pay for a SaaS license with them to tell you what other SaaS companies are doing within your organization. And I just think that the companies will get wiser and wiser. And whereas before, that £5,000 SaaS license, people had almost been apathetic to renewing it every single year, I think they're going to get wiser to it, and they're going to be much more concerned about the usage of it as that overall spend becomes bigger. And I think that will ultimately drive valuations down. And the real winners in the SaaS world will be those companies that are properly integrated in the processes of the companies and not just the sort of widgety type software that is the nice to have of key individuals within the organization. So not really what we're here to talk about. We're talking about how to make your business attractive for investment. Nothing investors love more than a KPI and a metric. And for some of you, you'll look at this slide and say it's pretty obvious. And of course, we know this and this is what we should be doing. There'll be others that this might be the first time you really thought that hard about your KPIs. And we see companies right across the board, people that are very KPI driven, and companies that really are quite naive to their KPIs. So some of the main ones here, and I've tried to bucket them best I can. Clearly, the way we value businesses tends to be on an ARR multiple basis. So to know your ARR, you need to know what your MRR is. ARR being a function of MRR times 12, and you need to know what your compound annual growth rate is. That's just the sort of fundamentals. The next bucket, lifetime value over CAC, the rule of 40, CAC payback. This is all about sales efficiency. So how anybody can spend huge amounts of money acquiring customers, but does that then pay for itself? So lifetime value over CAC is what's the lifetime value of a customer divided by the cost of acquiring that customer. A rule of thumb, you usually expect LTV to CAC to be between around about 3 times. So for every £1 you spend on acquiring the customer, you should make £3 from them. Rule of 40, it's a similar thing. It's a bit of a rule of thumb, but basically what this says is that your growth rate less your margin, your growth rate plus your margin should equal 40%. For example, if you're growing at 20% and your EBITDA margin is 20%, you've made the rule of 40. If you're growing at 100%, theoretically, you could afford a negative EBITDA margin of 60%. And really what this is trying to give is a rough picture that you're growing efficiently. And then CAC payback is around how quickly you can pay back the cost of acquiring that customer. And again, a rough rule of thumb is generally around a year. So if your average sort of annual value of a customer is £50,000, and it costs you £50,000 to acquire it, so you've got a one year CAC payback, that's about right. Unit economics and gross margin, going into a bit more detail. I think of this mainly for modeling and financial forecasting and why it's so important. Often you'll see a model where it will be, we think we'll be at £1 million revenue and we think revenue is going to grow by 50% every year. That's not how we want to think about the metrics. What we really want to do is go down to each individual license sale that you make and how much it's costing you to provide that license, and think of it in that way. So taking it right down to the individual sale when then building up a financial forecast and not just kind of increasing the headline numbers. Product usage, it used to be almost sort of de facto to say, we call our customers every 6 months and make sure they're using our products. And that simply isn't good enough now. Customer retention is so important that what we would say is you should have KPIs around how much your product is being used. And that should be integrated within your product. And if that goes down or it's not where it should be, you should be able to do something about it. Because if you're not monitoring that product usage and you're not making sure that it's at a good level, then it doesn't matter how many new sales that you make, ultimately you'll probably end up in a failing business. TAM, that stands for total addressable market. Your market is never every company in the entire world. Really understand what your TAM is and what niches that you play in. Churn, we're going to go on to in a bit more detail, but we often see a headline of churn. So our churn is, 10%, for example. But churn can be looked at in 3 main ways, which is logo churn, which is just a customer by customer basis. Gross churn, which is looking at your revenue you had from the previous year and how much of that revenue is left this year. So if all of that revenue is left from that customer, then it's 100. You've got 0 churn. Net revenue, either net revenue churn or net revenue retention, is about including any upsells within that number as well. So what does this mean in practice? This is an example, and with the time available, I don't think I'll go through it in a huge amount of detail, but this is an example of how you could look at churn with it being 90%, 69% on logo retention, 69% on gross revenue retention, or 68% on net revenue retention. The long and short of it is basically is understand how these different retentions are calculated and what they mean and why they are important. Now, if you're looking for a kind of idea around net revenue retention, and remember, net revenue retention is where you count your upsells. So you're looking at both your downsells and your upsells when you're calculating your retention metrics. Doesn't matter which kind of source of data, it always comes up to being around about 100% net revenue retention. What does that mean in practice? In practice, what it means is that you should be upselling your customers your existing customer base enough to make up for any customers that churn out. Hopefully that makes sense. So if you lose £10,000 worth of revenue for one customer, hopefully your upsells will make £10,000 on the other side, and you'll end up with a net revenue retention of about 100%. So flying through this, it's important from an investment point of view because, again, SaaS Capital, great resource for this type of information. For every 1% increase in revenue retention, the SaaS company valuation is likely to increase by 12% after 5 years. So, you can see that maybe increasing it only by 3-4% in terms of your retention can have a massive effect on your valuation. I've seen other statistics that say it's 6 times cheaper to retain an existing customer than it is to win a new one. And again, we see a lot of focus on new business wins, where actually what I think makes a really good, strong business is its ability to retain its existing customers. And if it's not doing that first, then that should be a focus. A fairly basic funnel here, but it's amazing how many companies don't do this. And we really look at this when we're looking at sort of pipeline and opportunity. And if you don't know, how many leads you're generating, how many of those leads hit meetings, how many meetings hit trials, and how many trials hit sales, and this is just a very basic pipeline. You could have all sorts of different categories here. Then it can be very difficult to make changes. And so one company I was working with recently, it was getting thousands of leads, but they weren't converting into trials. So it's somewhere in this process, it's breaking it down. And quite often we'll see a very broad pipeline, and it'll be a pipeline of hundreds of opportunities, and everything will have a 50% weighting to it, and then it'll equal a big number. But truly understanding the kind of conversion rates between leads and meetings and trials and sales can then lead on to understanding how long it will take you to close a deal, and how forecastable the next few years will be. Some mistakes and how to avoid them. And again, this is, as much as anything, a bit of a brain dump from me about the mistakes that I've just generally seen, what I think entrepreneurs make as they are raising funding, and particularly in SaaS. I see a lot of companies, they raise their first rounds really easily. They go to their friends, they go to their families, they go to early stage angels, and they sell them the dream and the concept of the business, and they raise a bit of money. And usually what happens is they don't raise quite enough money to then get them through what some people class as the valley of death. And I've seen the valley of death being categorized at different times. This is my own personal interpretation. It appears to be the sort of seed round. So once you pass those kind of angels and friends and family, and you're trying to get up to Series A, which, and there's definitely a much bigger wall of capital at around about 1 million ARR than there is at sort of even £500,000 worth of ARR, although that number is coming down. And people raise not quite enough money to get them through that kind of valley of death. So if you are an early stage SaaS business, really think hard about how much capital it's going to take you to get from the early stages through to that £1 million ARR. And if you are raising money, make sure you are planning that middle stage might be difficult to find cash as easily. Product market fit. No presentation is ever complete without a good 4x4 metric, and this one by Adam Fisher from Bessemer Venture Partners is one of my favorites, because I think product market fit's a really interesting topic. I'm not going to go through each quadrant here, but I wanted to touch on two mistakes that I see customers make. Vision down one side, customer engagement on the other. So the sexy story, and in SaaS businesses in particular, where I see this kind of sexy story play out from the marketing teams, is it's usually the conversation starts with, we are a machine learning, AI, blockchain company. So they're kind of using all the latest buzzwords, but there's no real customer engagement. It's all about the kind of the jazz, and none of the actual real whether customers want this product or not. It's not necessarily tackling a real problem. So it may look like a good vision, but do people actually want what you're trying to sell to them? And so, if you do start your stories by saying AI, machine learning, blockchain, then think really hard about that. Do you have customer engagement, or is it just a really good story? Kind of the other spectrum of that is on the revenue centric area, which is sales team driven. And where we see this in SaaS businesses is where you get a consulting firm that is moving into the SaaS world. So obviously SaaS companies much more profitable than consulting businesses for many reasons. And so consulting firms who have been maybe building products for their clients quite often pivot into a SaaS company. But when they do that, if they've still got that consulting feel and they're still sales team driven, they may end up chasing the very big fish, the big customers. They've become very customer concentrated and end up building lots of bespoke software for their customers, and that isn't product market fit. That's just kind of iterating on the iteration of their consulting world beforehand. So if you have got that, you must think about scale. You must say it might not always be the best thing to go after that big fish customer that wants 8 different iterations to your product, because in the long term, you're not getting a wider level of different customers engaging within your product. Pricing, which is something that we think about quite a lot, is how do you go about pricing a product? When you've got a physical product, it's usually you look at how much it costs you to make it, and then you put a margin on top of it, whatever that margin might be. Some people look at the competition. How much are my competitors selling this product for, and therefore what can I sell my product for? And certainly within SaaS, I think these are really bad ways of pricing your product, and you should look at them and price them on value. And there's a lot written about this. So I've used here the LeBron James card that recently got sold. So on a cost point of view, that LeBron James card is probably, I don't know, worth about $2, and it was probably $2 max. They put a bit of a margin. You could sell it for $3. Competition, I know there's other cards out there. Maybe they're $5, $10. But that was actually a card that was sold for, I think, just over $5 million. So somebody thought the value in that card was $5 million. It had nothing to do with cost of competition. And when you are pricing, it can be a real disruptor. But disrupting doesn't just mean cheaper. Disrupting might mean because you're adding more, you're offering more. So if you're a CRM, for example, you don't need to just price yourself at £1 cheaper than Salesforce. What is it that your CRM brings that provides value that other CRMs don't have? And talk to your customers, and what value do they perceive? And that's how you should be pricing yourself. Clearly, this is a whole topic of conversation. I'm sure there's going to be other seminars this week about that. So I think pricing for SaaS business is really, really difficult, because you can't just do your cost plus margin. You have to think about value. Moving on, very quick, sort of my quick fire things that sort of boil my blood when I hear it. SaaS companies that are starting to struggle with growth, so they think we just need to raise a bit of funding to get a CRO that's going to fix all your problems. Almost never does a new shiny CRO fix all your problems. It's usually because you need to talk to your customers and understand your sales pipeline and where it's getting stuck. So I'm not suggesting you shouldn't be hiring a new CRO. I'm just thinking that you might look inwards first and look where the sales pipeline is getting stuck before you do. So part-time CFOs, nothing wrong with a part-time CFO. Some of the best CFOs I know work part-time. But it's not just to tick a box and do a job. Your CFO should be somebody that is producing the KPIs we talked about and can help make decisions and drive your business. CEOs that are in love with their company so much that they believe they're only ones that can brand and market it. Just something we see, there are professional branding and marketing agencies that we introduce companies to that do nothing else but this, and they are better at it. But I think it's often the CEO, founder in particular, where the company's their baby. They want to be the ones that deal with all of that element. When people think about TAM, and they talk about TAM being the entire world, and they only need 1% of the entire world, and therefore they'll be very successful. This goes back to the unit economics point earlier. Think from the bottom up, how much it costs you to acquire each individual customer, and how much do you make from the individual customer, etc. One of my pet hates is when I ask a customer, a company, to explain why a particular customer churned, and they'll say because we lost our sponsor, we lost our key individual that loved our product and bought it. I think if you're losing customers because of specific individuals within companies, then your product is probably not integrated enough within that customer, and you need to do more to make sure that it isn't rely on on key individuals within the customer, and is just part of their processes. And probably the number one thing that we see companies do when they raise investment that's probably wrong or misguided is they spend a huge amount of time putting a massive deck together, 50-page, 100-page decks with lots of pretty pictures. We ask for the financial forecast and the financial model, and they say that it will be available in a few weeks. To be honest, most companies shouldn't need a deck of more than 15 pages. But what we do, or what our team particularly likes, is a really well thought out financial forecast where we can see what's driving your company through the assumptions that's being made for the future. So 3 parting takeaways that I've got. Spend time on your financial model and your KPIs and your unit economics, and use that data in order to drive your business. Make it a priority. The qualitative stuff is really important, but if you don't understand what numbers are driving your business, then you're going to find it very difficult to raise investment. When you're pricing your product, really talk to your customers and understand the value they're getting and price to that value. Don't price to what your competition is necessarily doing. And disrupting in pricing doesn't necessarily mean just being cheaper. It means finding the value that you're adding and pricing to that. And in terms of SaaS valuations, I'm not sure they're going to be around forever, but I do think the ones that are the true winners, the true SaaS products that will win, will be those that fully integrate their products within a business's, a customer's ways of working and processes. So it's really important that you monitor that, and that you ensure that your products are integrated within customers, and retain, and are not just nice to have. So, as I said, I have whistled through my presentation. I think probably quicker than ever. But if anyone has any questions, then please let me know. Gemma, I don't know if you want to read questions. Oh, I can't hear you, Gemma.
Me? Yeah.
I think Gemma's coming back on now. I'll try and see if I can find any other questions.
Hopefully, can you all hear me at all? There we go, I'm back.
I'm hearing you, yes.
Perfect.
Yeah.
So thank you so much for that presentation. I think that was really useful for people. Obviously, a lot of really sort of inside knowledge that people might not otherwise get. So we do actually have a few questions. So I will start with Jemima, who has asked, they said, you've mentioned some of the mistakes that people make when searching for investment. What would you say is the most common mistake that people make in terms of their pitch? And I think you actually covered quite a lot of that, but are there any sort of further points that you had?
The most common mistake is definitely the lack of understanding of truly what is driving their business in terms of the KPIs. So understanding what it costs to acquire a customer, understanding what they make from that customer, and then using that to forecast out where the business might.
I think perhaps we have lost Edwin. So what we'll do, I will have a look through these questions. If we do have any further problems with Edward's signal, what we'll do, we'll try to get him back in a moment, and then I can always have a look through the questions afterwards. So you can actually catch Edward on our Slack channel, so you can always ask them there. I think quite a few of those, it was a really helpful presentation, so he did actually cover quite a lot there. So hopefully you can all, you've all sort of gained what you wanted to gain from that presentation. Join us on Slack afterwards. We'll give Edward just a couple of minutes to try and join again, and we'll see how that goes. So it looks like we have lost Edward, unfortunately, but thank you everyone so much for joining us. The time is coming to a close now. As I mentioned, you can absolutely jump onto the Slack, post those questions there. What I'll do is I'll post the link to the Slack in this chat just here. So you'll be able to follow that through, catch Edward on Slack and ask your questions there. Thank you all so much for joining us, and thank you again to Edward. Unfortunately, we've lost him, but it was a really great presentation and hope you all enjoyed it. Thanks very much for joining us.